In this video, I'll be talking about index funds and why they make a profit 100% of the time. The main condition for this is that you need to have a long enough investment time period investing in the index fund. Preferably, you're looking at around 20 years time period. Now, in March of 2021, the US financial research firm JP Morgan released a guide to the market. So they did a research from 1950 all the way to 2020 over a 70-year period of time. They have found that if you invested in the S&P 500 index fund, which covers the 500 biggest company in the US, for only 1 year, the maximum return is 47%, while the lowest return is 39%. So there is a decent chance of you losing money if you only invest for 1 year. However, if you continuously invest for 20 years during that period of time, the maximum that you get is 17%, and the lowest that you can get is 6% per year. So this means that if you have invested for a long enough period, you would always get a positive return, and you simply cannot lose. Now, why is this the case? It's no surprise that I personally love investing in index funds, and I'll talk about the reason why index investing is so good for the average investor that doesn't have the time or simply doesn't want to do lots of research on individual companies. Now, personally, I do company research because I like reading company financial reports. But most other people have better things to do with their time, like hanging out with their family or pursuing other hobbies. Personally, the biggest part of my portfolio is invested in index funds. Now, I have videos on some good index funds to invest in, whether it be with Vanguard in the US market or locally with InvestNow. So be sure to check them out if you haven't already. To understand why index fund investing works so well, we need to look at where an index fund comes from. Now, there are two components to an index fund. The first, you have the company that creates the index. Now, the most famous index is probably the S&P 500 index, and this index is created and maintained by the S&P Selection Committee. So S&P stands for Standard & Poor, which is the financial company that makes these indexes. Now, they get together multiple times throughout the year and decide on which company should be included or removed from the index. Now, they have a particular set of selection criteria for a company to be selected into the index. For the S&P 500, as of June 2021, a company is required to have a market cap of $13.1 billion. Its value of its market cap is traded annually, which means the company has a fairly high liquidity, and at least 250,000 of its shares are traded in each of the previous 6 months. And most of its shares are in public hands, so they're not privately owned, and at least a year since their initial public offering. Also, the sum of the previous 4 quarters of earning must be positive, and the most recent quarter also needs to be positive as well. So basically, it's a company that is earning money. Now, the second component are the fund managers that package financial products that track a particular index. So these could be fund managers like Vanguard or BlackRock or SmartShares in New Zealand. Although SmartShares is kind of cheating because they just repackage Vanguard funds and just act as the middleman to sell these funds to people in New Zealand while charging a fee for doing that. In either case, the first reason why I like index funds is that they always make a profit in the long term. Now, they achieve this by literally picking big companies that make money. Now, if a new company is doing really well and suddenly starts to rival Microsoft or Apple, it is highly likely that they would be selected and be included into the index. And you don't have to do anything at all as your average investor. All you need to do is to just buy the index fund. An example of this would be Tesla. So Tesla was included in the S&P 500 when it started earning money. Now, on the other hand, if a company constantly performs poorly, it may be removed from the index. So index funds always make profit over the long term because they literally only pick winners. It's like playing a team sport, and after every game, you literally pick the best player on the other team and then add them to your team and cut the worst player from your current team. So eventually you would end up with some sort of super team that has almost all of the best players. And that's kind of what an index fund is. Now with an index fund, you still get smart people crunching numbers on a company to pick out the best companies to include in the index. But they charge much less fees because they are not trying to actively buy and sell stocks all the time, like an actively managed fund. It's important to note that not all index funds are created equal. Indexes in different sectors can have very different selection criteria. So if you are unsure, just stick with the main ones like the S&P 500 index funds, or the Total World Index, or even the New Zealand Top 50 Index. The second reason why index investing is good for the average investor is because it saves a tremendous amount of time on researching individual companies. Now, I absolutely believe that you can make more profit doing research and buying individual companies. But unless you really like reading financial reports, which I'm assuming that most people don't, you are far more likely to make more money simply working on your day job than doing little trades here and there on individual companies. As I often say, people should do their own research themselves and not just listen to some person on the internet saying, I'm going all in on Tesla, or I'm going all in on GameStop, or some other company out there. Again, I do personally invest in individual companies, so I'm not saying investing in companies is bad, but the majority of my investment is in index funds. The third reason why index investing is good for the average investors is that you can compound the returns. Now, I know that if I put $100 a week in a portfolio with a good index fund like the S&P 500, after 20 years, I can say with 99% certainty that my portfolio size would have increased. Now, can you say the same with a company like Tesla? Can you safely say with 99% certainty that Tesla will still be the biggest electric car maker in 20 years? Can you be sure that another company won't just appear and take its market share? Can you say the same with cryptocurrency? Can you safely say that you know what crypto will be like in the next 20 years? Now, if you look at the landscape 20 years ago, Tesla and crypto didn't really exist, and Amazon barely got started. And are you confident that you can predict what's going to happen in the next 20 years? Realistically, predicting the future is extremely hard, and even experts have a real problem of being able to do it consistently. So for these three reasons, number one, index funds pick the biggest winners. And number two, you can save a lot of time. And number three, the ability to invest for compounding interest for the long term makes index investing one of the best options for average investors. Now, people have asked for my personal investing strategy, which I will cover in another video.